Welcome back to the channel, everybody. In today's video, we are going to be doing an ETF tier list. Now, these ETFs, the way I'm going to rank them, are going to be basically what I would invest in for 2026 and my long-term future. A lot of these ETFs on this list, I actually do already invest in, and potentially these are some that if you didn't know about, you could start investing in yourself. Now, look. By no means am I a financial advisor, or do I really know what I'm talking about, right? I've been investing for about 2 years now, and if you don't really know what an ETF is, basically all an ETF is I'd say it's the lowest barrier way to start investing. An ETF is like a big basket of stocks. So when you go and you buy a stock, you're not buying an individual stock. You're actually buying a certain amount of stocks that make up that ETF. So for example, something like VU, which tracks the S&P 500, when you buy one share of VU, you're buying diversity over 500 different stocks. So that's kind of how ETFs work. They make it very simple to start investing, and they just make it a lot less stressful when it comes to investing because you're not picking individual stocks. Now, we're going to go from S tier to F tier on what I would buy and hold forever versus what I wouldn't invest my money into. And at the end of the day, too, when it comes to ETFs, there's a lot of nuances. So, for example, if you're looking at an S&P 500 ETF, there might be 5 or 6 different ones that track the S&P 500, and they all might be very similar aside from maybe a little bit of a different expense ratio or X, Y, and Z. So if I put VU in the S tier and then you say, well, there's an ETF that's similar to VU that has a low expense ratio, just know that I'd probably put that in the S tier as well, because at the end of the day, if I were to rank every ETF, we'd probably be here for about 7 hours. So I'm going to, rank, in my opinion, probably what I would say is the most popular ones, or at least the ones I know of the most. But I say all that to say that there's a lot of ETFs out there, there's a lot of overlap, and there's a lot of similar ETFs to what I'm going to talk about. So just keep that mental note that if there's an ETF you invest in that's not on the list, but there's one similar, I'd probably rank it right around that category. So enough yapping, let's get into the video. Let's start ranking these ETFs. All right, so first on the list is IWY. Now this is the iShares Russell Top 200 Growth ETF. This one is basically all about large cap growth instead of owning the entire market. It pretty much focuses specifically on the fastest growing companies among the biggest US stocks. So you're basically getting a very targeted slice of the market that's designed for capital appreciation when you buy this stock. Now, if you look at the holdings for IWY, it's basically loaded with names that a lot of people already associate with growth, right? So you'll see heavy exposure to companies like Nvidia, Microsoft, Apple, Amazon, Google, and Meta. And because of that, this ETF tends to move very closely with big tech and innovation trends. And when growth stocks are leading, IWY usually does perform pretty well over the years. But when growth cools off, you kind of feel it more because it's not as broad as some of the other funds on this list. Now, for me, and the reason why I'm putting IWY where I want to put it is because I think it's a strong term growth ETF, but it's more concentrated than something like VU or VTI. And it also costs a little more than some of the other growth options. So what I mean by that is with every ETF, you're going to pay fees. And with IWY, you're paying about a 0.2% fee, which isn't bad, but it is higher than some of the other alternatives on this list, like SCHG or VUG. So if you want growth exposure that's a little bit more aggressive and more focused on the biggest winners, IWY does make a lot of sense to invest your money into. Now, if you want something a bit smoother and a little bit cheaper, some funds like VUG or IWF are very similar, but they're a little bit more diversified. So overall, IWY is a great ETF for investors who believe in that large cap growth and that tech will continue to perform very well, which is something that I do believe in. So in my opinion, I put IWY in the A tier. Even though it has that little bit of a higher expense ratio, I do think it is a good stock to invest your money into. Next up on the list is AVUV, which is the Avantis US Small Cap Value ETF. Now, this one isn't a big cap tech or total market fund. It's focused on those small cap value stocks in the US stock market, meaning it basically looks for smaller companies in size that the managers believe are undervalued relative to their fundamentals. And it's an actively managed ETF. So there's a team picking stocks rather than just tracking a specific index. So basically, kind of plainly as possible, this fund is built around the idea that smaller companies with good value characteristics can outperform the market over long stretches, especially when value eventually cycles back into their favor. And once you dig into the holdings, you basically find a really broad mix of smaller businesses like regional operators, industrials, consumer names, and other companies that kind of fly under the radar out of those mega cap kind of big growth companies you see in some ETFs. Now, the expense ratio on AVUV sits around 0.25%, which is definitely higher than many core index ETFs, but still relatively reasonable for an actively managed kind of value strategy in the small cap space. AVUV also pays modest dividend yield, so adding a little more income component to its return profile, which can definitely help, that investor mindset over the long haul. Now, for me, I'm personally going to put AVUV in the C tier. I think it serves a specific role in if you have a diversified portfolio. I think you could definitely mix this in. Small cap value can outperform in the right environment, and it has a broad base with hundreds of holdings, which definitely helps reduce that kind of single stock risk that could come up. That being said, though, it is a small cap value, and inherently it's a little bit more volatile and unpredictable than those large cap or broad market ETFs. So in short, AVUV, right, it's a strong choice for a very niche value exposure, especially if you personally, as an investor, like buying small companies that have maybe attractive valuations. Now, next up on the list is VTI. Now, this is the Vanguard Total Stock Market ETF. Now, basically, with VTI, this one is about as simple and as powerful as it gets. VTI will give you exposure to basically the entire US stock market in one fund. So you get large caps, you get mid caps, and you get small caps. It's all wrapped up in this ETF. Now, if a company is publicly traded in the US, more than likely it's sitting in this ETF. And when you look at the holdings, the top names are exactly what you'd expect, right? You got Apple, Microsoft, Amazon, Nvidia, Google, Meta. But what makes VTI special isn't just the top of its holdings. It's the thousands of smaller companies underneath that you don't get with something like VU, right? This is like the final boss of like diversified investing or a diversified ETF. And that extra exposure gives you broader diversification and lets you benefit if smaller companies do outperform the market over time. Now, in my opinion, pretty simple. This is an S tier ETF, just for the simple fact that it works for almost everyone. This can sit in anyone's portfolio and it would make sense, right? Almost every long-term strategy, this makes sense. And the expense ratio is extremely low. It's very tax efficient, and it doesn't require you to make any bets based on sectors, styles, or certain market cycles. You're basically just betting on continued growth of the US economy over decades to come. So if you want to compare it to some similar ETFs, yeah, it's going to be kind of overlapped with VU. That's a close alternative. But once again, in my opinion, this is just bottom line. If someone asked me to pick one ETF and hold it for the next 20 or 30 years with the most diversification and the most confidence, more than likely VTI is going to absolutely be in that conversation. And that's why, in my opinion, it's just a solid S tier forever holding ETF. And one thing I do want to say before I go to the next one is I'm not ranking any of these ETFs based on total returns for the past years. This is more so things that I think you can invest in and be confident with. I just wanted to say that because I'm sure I'm going to have someone point it out and say, well, this ETF performed better than this ETF, so why is it lower ranked? This is not based on total returns. Just want to get that out of the way. But the next one here is QQQM. Now, this is actually the second largest holding in my Roth IRA. I am an investor in QQQM, and it's done very well for me. And basically, QQQM is essentially the NASDAQ 100 in ETF form. This fund will track the 100 largest non-financial companies listed on the NASDAQ. So you're getting heavy exposure to tech and growth-oriented businesses. You can think of software, AI, and just big tech. If those are your long-term bets, this kind of ETF kind of sits right in the center of those different sectors. And the top holdings look very similar to a lot of these other top holdings, right? You're going to have Apple, Microsoft, Nvidia, Amazon, Meta, Google, Tesla, kind of what you would expect. And these companies make up a huge portion of the fund, which means performance is very dependent on how these mega cap companies are doing when it comes to technology. Now, when tech is leading the market, QQQM is usually a great investment. Like, it's going to outperform, it's going to do very well. But when tech struggles, that's when you're going to feel it a little bit more, since it is so heavily weighted into some of those major tech stocks. Now, the reason I know I'm going to get this question saying, what's the difference between QQQM and QQQ? The reason I like QQQM over QQQ, Jesus, that's a lot of Qs, is the lower expense ratio. QQQM was designed for long-term investors and not traders. So you're getting the same exposure, but at a cheaper cost over decades. And over decades, when you're investing, those fees do add up, right? They actually do matter. So for me, even though this is the second largest holding in my Roth IRA, I'm not going to put it in the S tier. I am going to put it in the A tier, though, because it's an incredible growth kind of ETF, in my opinion. It's not fully diversified, right? So I got to knock it a little bit. There's no financial sector exposure, so I got to knock a little bit. And it's very concentrated in a handful of large tech names. So that does make it a little bit more volatile. And once again, this list is kind of a stress-free list, right? We want stress-free investments here. But I do think it's still a fantastic long-term ETF, especially if you believe in technology and innovation, which I do, and you believe that those sectors will continue to outperform, which I do. I think it's a great ETF. Next up is VT. Now, this is the Vanguard Total World Stock ETF. Now, in my opinion, this is probably the final boss of diversification, right? This is the most hands-off, set it and forget it ETF you can probably own. VT will give you exposure to the entire global, not just the US, this is all global stock market in one fund. So think of US stocks, international developed markets, and emerging markets all wrapped together. Now, at the top of VT's holdings, you'll see, once again, very familiar US names like Apple, Microsoft, Nvidia, Amazon, and Google. But the difference is everything underneath. VT owns thousands of companies across Europe, Asia, and emerging markets like China, India, and Brazil. So you're not just betting on the US at this point, you're literally betting on the entire global economy to go up as a whole. So in my opinion, this is probably actually the final boss of, like I said, diversification. This is an easy F tier because it's simple and it's diversified. With one fund, you eliminate the need to rebalance between US and international stocks, and you never have to guess which country will outperform next because you own the whole world, basically. So the expense ratio also is very low for a global fund, which makes it, once again, very easy to hold. This is something you could add to your core holdings, or you could just buy one ETF. You could buy something like VT and really never have to worry about it again. Now, the only real downside with VT, in my opinion, is that international stocks can lag versus the US stocks for long stretches, which makes VT feel a little bit slower at times in comparison to some of the US focused ETFs. But over decades, that global diversification can and will reduce risk and smooth out your returns. So if someone wants to buy one ETF that they can hold, buy, hold forever and never think about it again, has to be kind of at the top of your list. Next up on the list is IDRV, which is one you might not have heard of before, but I know this is a market that some people who talk about investing want to get their money into, and this is an ETF that you could do that with. Now, this is the iShares Self-Driving EV and Tech ETF. Now, this is a thematic ETF, meaning it's built around a specific idea. So this idea is that you're basically betting on electric vehicles, autonomous driving, and the technology that supports electric vehicles and autonomous driving. So instead of owning the whole market, at this point, you're really narrowing down your holdings. You're making a focused bet on how transportation will evolve over time. And when you look at the holdings, it is not only car companies, but you're also going to see chip makers and tech companies like Nvidia and Qualcomm and other suppliers that give, power batteries, sensors, and autonomous driving systems. So that gives it a bit more depth than a pure EV car ETF, but it's still very kind of theme driven. IDRV, it can make sense as a small position in your portfolio, or if you're an investor who really believes in the future of, autonomous vehicles and self-driving. If you really believe in that and you have high conviction, this could be an ETF that you might want to invest your money into. But for someone like me, who it's like, I want hands-off, stress-free investing, I want easy long-term growth, this is an F tier for me. It's just something I personally would not invest my money into. Plus, two, while I do believe autonomous vehicles and EV cars are something that are going to blow up in the next couple of years, I just don't have super high conviction to buy this stock in comparison to some of the other names on this list. Next up on the list is VXUS. Now, this is the Vanguard Total International Stock ETF. And this one basically gives you exposure to everything outside the US. Developed markets like Europe and Japan, plus emerging markets like China, India, and Brazil. So think of VT, but rip out the US, right? That's kind of what we're looking with here. Now, at the top of the holdings, you'll see very large international companies like Nestle, Samsung, Toyota, ASML, and more, right? But just like VTI, the real value isn't only at the top. It's the thousands of companies underneath across these different countries, across these different currencies and economies. So you're spreading your risk out way further beyond the US stock market, which for long-term investors can make a lot of sense. Now, for me, I think VXUS plays a really important role, but it's not something that, in my opinion, you would want to hold just by itself. Like, you wouldn't want to do a single ETF portfolio and only hold this, in my opinion, because kind of how I mentioned with VT, international stocks can lag versus the US for long stretches. And that can test your patience if you see, a US sector doing very well and you're missing out on some of those gains. But that being said, there have been full decades where international, stocks have outperformed the US, and owning VXUS can help protect you from being too concentrated in the US stock market. So overall, this ETF is strong. It's a very long-term diversification tool, and it's not flashy, right? But it does the important job in your portfolio of kind of spreading out your risk as much as you can. Now, with that being said, me personally, I'm still going to put VXUS in the B tier category. I think it's kind of right in the middle ground. It's not something I personally invest in, but I also don't think it's C tier, F tier. I don't think it's a bad investment at all. Next up on the list is SMH. Now, this is actually my third largest holding in my Roth IRA. I really like this stock, and this stock has done very, very well over the past year. Now, SMH is the Semiconductor ETF. So this one is focused on playing into the semiconductor industry, which is basically the backbone of modern technology, right? As we know, chips power everything from smartphones to cloud computing to AI, data centers, cars, defense systems, graphics cards, whatever you want, right? So this ETF is tied directly to long-term tech demand. Now, when you look at the holdings, it's kind of who you would expect when you think of chip makers, right? You're going to see NVIDIA, then you're going to see Taiwan Semiconductor, you're going to see ASML, you're going to see AMD, you're going to see Broadcom, and these are companies designing, manufacturing, and supplying some of the most important technology chips in the world. And because of that, SMH tends to be more volatile than broader tech ETFs, but it also has that really high upside that we saw last year when the cycle is in its favor. Now, for me, I'm going to put SMH at the A tier. I love SMH. I think it's been a great investment for me. It is definitely a little bit more volatile than some of the others, but the growth side is there. And the reason I'm doing this is because semiconductors are critical, right? They're critical to long-term growth technology, especially with AI. And that said, this industry is very cyclical, right? So chip stocks can go through big booms and they can go through deep pullbacks. So this ETF, once again, it's not for everyone, but it's an excellent long-term ETF if you understand why the volatility is there and treat it as a growth accelerator rather than just like your core main holding. So that's why I said it's my third biggest position in my Roth IRA, because I do treat it as a growth accelerator. I don't only invest my money into SMH, but once again, as a young guy with a long way to go and who believes in technology, I think SMH is a great pick for anyone. Next up on the list is VOO, or you've probably heard VOO, and this is just the absolute classic S&P 500 tracker, in my opinion, right? VU tracks the S&P 500. Oh, by the way, this is the Vanguard S&P 500 ETF. And basically what that means is you're owning the 500 largest publicly traded companies in the US. It's that simple. It's very efficient. And for most people, this has been one of the most reliable ways to build long-term wealth. I think VU is probably the most popular ETF. You can tell me if I'm wrong on that, but it's the first ETF I started investing my money into. And this right here in my Roth IRA and my taxable brokerage account is the largest holding that I have in any of my accounts. I invest into VU very heavily. I invest into VU daily. It's just a solid performer, right? And when you look at the holdings, very similar to a lot of these big ETFs, right? You're going to see Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Berkshire Hathaway. And these companies make up big chunks of the fund, so performance is driven by the strongest businesses in the US economy. And over time, that's just been very powerful, right? It's been something that's easy to put your money into, and you're going to expect, easy gains out of it. Now, in my opinion, this shouldn't be a surprise. VU is going to be S tier. It hits that perfect balance between growth, diversification, and cost. And the expense ratio on VU is extremely low. It's very easy to understand, and it doesn't require you to guess which sectors or styles will win. Like if you're an entry-level investor, and like I said, this is the first time you ever start investing, you're just learning about ETFs, VU is the one that I would take my time and learn about. And once again, this is the first ETF I ever invested my money in, so I have a little bit of a soft spot for VU. Next up on the list is SCHG. Now this is the Schwab US Large Cap Growth ETF, and this one's pretty straightforward, right? This is large cap growth funds that focuses on US companies with strong growth characteristics. You're going to see a trend with a lot of these. They focus on US or non-US, and they have large cap companies, right? And it's designed to capture long-term growth without getting overly complex or expensive. And when you look at the holdings, I'm not even going to say the holdings because they're the same holdings that I've mentioned in half the other ETFs, right? Very similar. And it definitely does heavily overlap with ETFs like QQQM and VUG, but it's built a bit more evenly, and it doesn't lean as hard into one single sector as some of the other ones might. So you still get strong tech exposure, but it's spread across more industries. Now, I'm going to put SCHG in the A tier. It's kind of a wash when it comes to like QQQM or SCHG. Like they're going to both do you very well. In my opinion, overall, SCHG is just a strong choice if you want long-term growth without going all in on one, specific tech sector or paying any higher fees, right? This is a very reliable ETF, and I know a lot of people who invest their money into SCHG. Next up on the list is DGRO. Now, this is the iShares Core Dividend Growth ETF, and this one's built around companies that consistently grow their dividends over time, rather than just paying the highest yield. So instead of chasing income, the focus here is quality and cash flow, but also having long-term durability. And when you look at the holdings, you'll see a lot of well-established names. Once again, Microsoft, Apple, Broadcom, JP Morgan, and United Health. Now, these are profitable companies with strong balance sheets and a track record of increasing payouts year after year. So you still get growth, but it's paired with some dividend stability. Now, for me, this ETF, it does fit very nice into a long-term portfolio, especially as it grows over time. It's less volatile than some of those pure growth ETFs that we've talked about. The expense ratio is low, and dividend growth approach can help protect some of your purchasing power when it comes to inflation. There's this big conversation where it's like, do I dividend invest? Do I growth invest? As a younger guy with a long-term outlook, I prefer to growth invest versus dividend invest, but to each their own, right? And it's not designed to be this, big growth ETF. It's more so designed to be kind of a reliable one. And, in my opinion, it's a great ETF if you want steady growth and you want some of that dividend kind of utility as well. But for me and my outlook and how the market's performing, I'm going to put DGRO in the B tier. I think it's kind of right in the mid ground. I think it's a mid-tier, dividend investment, but it's not something that I would personally recommend too many younger people investing their money into. You're better off going with something in the S tier or the A tier, in my opinion. Next on the list here is USMV, and this might be one that you haven't heard of before. And this is the iShares MSCI USA minimum volatility ETF. And that's just an absolute mouthful. Pause on that. This ETF is designed to do one main thing. It's basically designed to even out your portfolio, reduce risk, and reduce portfolio swings up or down. So instead of chasing high returns, it focuses on US stocks that historically move around a lot less than the broader stock market. So this is one where, once again, as a younger guy, I wouldn't recommend investing too much money into this, but if you're watching this video and you're a little bit older or you're planning to cash out soon and you want to protect your money, this could be a very decent investment for you. And when you look at the holdings, it's very different from a growth ETF, right? You'll still see some large, well-known companies, but the fund leans more towards defensive sectors like healthcare, consumer staples, and utilities. So the idea is to smooth out the volatility, especially during market drawdowns, even if that means lagging a bit during market, bull markets and stuff like that. So you're not going to see the growth, but you're also not going to see the decreases. So for me, when it comes to the outlook on this, it plays a very specific role. It can be extremely useful for those investors who are looking for low volatility, downside protection, and just a more conservative tilt as their portfolio continues to grow. But however, in bull markets, it's definitely going to underperform pretty much every stock on this, every ETF on this list, right? So if you're in this for the long run, once again, I wouldn't necessarily recommend putting your money into this, but if you want to protect a certain amount of your portfolio, it definitely doesn't hurt putting your money in here. Now, overall, it makes sense. It's a stabilizer. So in my opinion, I'm going to put this in the C tier. Once again, this is one of those ETFs that depends very heavily on your current situation. In my current situation, I'm putting it right in the C tier. Next up on the list is ARK Innovation ETF, and this is a very talked about ETF over the last few years, and it's a perfect example of why hype and long-term investing don't always mix too much. ARK is an actively managed fund that focuses on disruptive innovation, quotations, right? Things like AI, robotics, fintech, and just next generation internet companies. And when you look at the holdings, you're going to see names like Tesla, you're going to see names like Coinbase, Roku, and some other high-growth, high-risk companies. And this portfolio can and will change a lot because the fund managers are constantly adjusting based on their outlook. And that makes ARK very different from some other index ETFs. It also makes it a lot harder to rely on. Now, the idea sounds great, right? And the execution has been extremely volatile with this ETF. So performance has been inconsistent. And there's been massive drawdowns over the years. I know you're going to see this like green up here, but if you look at the 5-year chart, it's been up and down. And that makes it kind of a hard long-term play, right? Like it makes it, you don't have the most confidence when you're investing in something like this for the long term. In my opinion, if you want something like ARK, you're so much better investing into QQQM because you're going to get still relatively the same exposure with a lot less of the downsides, and you're going to pay a little bit less for it. Now, ARK, it can make sense, once again, if this is a very small part of your portfolio and you kind of just want to see what happens and see if you can get some big swings upward, but it's very speculative in my opinion. So only position this if you actually understand what you're getting yourself into and if this is something you actually want to buy into. But for long-term investing, this is just an F tier for me. I personally wouldn't recommend any newer investors or just any investors putting your money into ARK. There's, as you can see up here, there's way better places you can put your money that you can guarantee growth versus ARK. Next up on the list is BERKB, and this is Berkshire Hathaway. And technically, this actually isn't an ETF, right? But I still absolutely think it does belong in this conversation because it's basically a one-stock portfolio run by some of the best capital allocators of all time. And when you look at what Berkshire owns, it's a mix of massive public companies and entire private businesses. So on the stock side, you've got something like Apple as the largest position, along with names like Bank of America, Coca-Cola, Amex, and Chevron. And on top of that, BERKB owns full businesses like Geico, and just a huge collection of cash generating operations that a lot of people never actually think about investing their money into. Now, it's very unique, right? You get strong diversification, you get strong downside protection, and disciplined capital allocation, kind of all wrapped up into one stock. And Berkshire doesn't pay a dividend, but that's intentional because profits always get reinvested internally, which has historically worked incredibly well for those long-term investors. Now, if someone wants long-term exposure to high-quality businesses without having to constantly rebalance or chase certain trends, Berk fits here perfectly, and it behaves like an actively managed ETF, but you have that long-term mindset and zero expense ratio. Now, over the past year, Berk was kind of flat at 9%, which I know isn't really flat. 9% growth is still good. So I know it hasn't grown as much as some of these other ETFs on this list, but for what it is and the fundamentals that it deploys, I still think it's an S-tier investment. I still think anyone can confidently invest into Berk B and feel very happy about what their money is doing for them and where their money is going, even though, as you can see, it's a little bit more choppy on this graph than some of the others. Next up on the list is JEPI, and this is the JP Morgan Equity Premium Income ETF. And this one's very popular, especially with income-focused investors because it pays a high monthly yield, but it's important to understand how that income is generated before you call it a good long-term investment. Now, JEPI holds a portfolio of large, high-quality U.S. stocks. Once again, names very similar to what you'd see in the S&P 500. But the key difference is the option strategy layered on top of it. And the fund sells covered calls through equity-linked notes, which generates income, but it also caps the upside when the market is moving higher. And you can see this is the first ETF on this list that was actually red over the past year. Now, when it comes to, long-term investing, it's not really designed to maximize growth. And income looks great on paper. Like, why wouldn't you invest in something that can generate you income? But over long periods, that capped upside can seriously limit your total returns and your total growth. So would you really want the income if you're missing out on 20% gains on a yearly basis? So JEPI, in my opinion, it can make sense for certain people or investors who need the income right now. But for younger investors or anyone focused on building wealth over decades, it's more of a niche kind of income generating tool than a core holding or something that I'd want to put my money into. For JEPI, I'm going to put it in the C tier. I think it's good, but it's very conditional. It definitely matters your outlook on investing. And once again, I would just invest in anything. I would pick any other ETF that's B tier and higher on this list before I put money into JEPI. Next up on the list is SCHD, which was actually an investment that I had and I sold out of in the middle of last year, and I haven't invested my money back into it again. But SCHD is the Schwab US Dividend Equity ETF, and this is one of the most popular dividend ETFs out there, and for good reason, right? SCHD focuses on high-quality US companies that pay strong, reliable dividends, but it also screens for fundamentals like profitability, cash flow, and just overall how strong the balance sheet is for each company. And when you look at the holdings, you're going to see a lot of different names in comparison to what we've talked about. You're going to see names like Pepsi. You're going to see names like Coca-Cola, Home Depot, Texas Instruments, and major financial and industrial firms. And these are businesses that tend to hold up very well across different market environments and consistently return cash to shareholders. Now, SCHD, right, it's a really good balance between income and stability. It's not very growth focused, but if you want that stability and you want some dividend payout, it's definitely a good stock to invest your money into. Now, the yield is meaningfully higher than the market, and the expense ratio for SCHD is very low. And the quality screen definitely helps avoid a lot of the weaker dividend payers, but it's not built for, like I said, that explosive growth. So overall, SCHD is a great long-term ETF for investors who want income, they want kind of that lower volatility, and especially as your portfolio matures and you want to protect some of your money and maybe get out of growth and focus more on, how can I increase income and keep my portfolio pretty steady. Now, for my outlook and my position, I'm going to put SCHD in the B tier. I don't really think it's any higher than that, but I know if you're a little bit of an older investor out there, this can definitely be easily an A tier investment for you and for your portfolio. And to round off the list here, we have VGT, which is the Vanguard Information Technology ETF. Now, this is actually in my taxable brokerage account. This is the second biggest holding I have, and this is a pure tech ETF, right? This is not growth in general, not the whole market. This is literally just US technology companies. So if you want direct exposure to the tech sector without mixing in other industries, this is one of the easiest, cleanest ways to get in there. Now, there's no secret that technology has performed very well over the past couple years, and technology continues to be a massive long-term driver of productivity, innovation, and just overall earnings. And, there's things like AI and cloud computing, just everything sits all inside of this ETF. And the expense ratio is also extremely low, which makes it very attractive for people like me who plan to invest for the long term. And the reason, in my opinion, where I'm going to rank it where it is because it's an excellent growth accelerator. If you believe technology will remain a dominant force over the next decade, which I personally do, I think it's great. Now, with that being said, I'm going to put it in the A tier, and the reason I'm not putting it in the S tier is pretty much all the things I said good about it are also what holds it back a little. You're not getting that full exposure out of tech. So if tech has drawdowns or is very volatile, which it has been, it's going to, lower your portfolio in comparison to stuff that's in the S tier. So take that in mind that this is a pure technology ETF, which is great if you believe in technology. But when technology does have, pullbacks, which it definitely does, we saw a lot of pullbacks last year in technology, this, ETF will be effective negatively. So that is my tier list for all the ETFs that I think are pretty popular and you guys have probably heard of if you're somewhat into investing or anything like that. Now, let me know what you agree with and what you disagree with in the comments down below. Also, I know like I said, there's so many different ETFs, right? These are the ones that I know of and that I invest in. I know I missed very similar ones, so let me know what you invest your money into, right? What are your core holdings? What are the ETFs that you like to put your money into? And what did I miss on this list that you've been investing in for a decent amount of time now? Now, I appreciate you guys for watching this video. I hope you guys have a great day, and I'll catch you guys in the next one. See ya.